Roth conversions are one of the most popular tax planning tools among retirees today, and we're going to spend this entire episode answering your questions about Roth conversions so you can better understand both the obvious and the subtle reasons to either pursue Roth conversions or not.
Welcome to Personal Finance for Long-Term Investors, where every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Welcome to Personal Finance for Long-Term Investors, episode 145. I'm Jesse Kramer. I'm a financial planner working with retirees and also with busy professionals who are getting ready for retirement from all across the USA. You can learn more at planwithjesse.com. Today's review of the week comes from username Going to Retire. Great username, who left me very kind words, but only a 3-star review on Apple Podcasts. It's actually the second time that's happened where I had a wonderfully kind review, but only 3 stars. That's okay. The words mean far more than the stars, and I'd be happy to mail you a super soft t-shirt. So username Going to Retire, reach out to me via email, jesse@bestinterest.blog, and I'll get that t-shirt sent out to you. And as a reminder, listeners, you can submit your questions to future Ask Me Anything episodes by emailing me at jesse@bestinterest.blog. I'll answer those questions on a future AMA. Now, before we get to the specific questions from you about Roth conversions today, I'm going to spend a few minutes kind of priming you listeners with some of the basics of Roth conversions in case you're not quite familiar with them. So we'll talk about the very basic how it works of Roth conversions, who might be a good candidate, when are the typical best years to consider Roth conversions, what might get in the way of doing them, and then how do you measure if you were successful ultimately in your Roth conversions? So let's just get diving straight into it. The very basics. A Roth conversion occurs when you move dollars from a pre-tax, aka traditional retirement account, usually it's from a traditional IRA, directly into a Roth account. Usually it's a Roth IRA. Most of the time, because those dollars have never been charged a cent of income tax, this conversion from traditional to Roth counts as a taxable event. The amount of dollars that you convert usually counts to you fully as income in the year that you do it. So in that way, you are intentionally realizing income with a Roth conversion, and you are therefore intentionally choosing to pay more taxes this year. So why would anyone ever intentionally pay more taxes? Well, that gets us to our next question: who might be a good candidate? Good candidates for Roth conversions are people who look at their financial plan and look years out into the future, and they realize that their future years might involve much higher tax rates, while their current years involve quite low tax rates. And there are many reasons why this might happen in your financial plan, but perhaps the most common one could be something like, okay, Bill and Linda have retired at 58. They have about $4 million total. About $2.5 million of it is in their traditional IRAs from former workplace 401k accounts. They really don't have much income right now because, again, they're retired. They're 58 years old. They have some dividends. They have some interest from their bank accounts, some dividends from their taxable investment account, but no Social Security, no outside income. And so their marginal dollar when they file their taxes is only getting taxed at about 12%. But as they project how their financial plan will evolve and how their accounts might grow over time, they look at the numbers and their traditional IRAs might easily be $5 million by the time they're age 75, which is when RMDs would start for them. And they'll be collecting Social Security at that age too, and that's more income in their life. And when they look at this set of facts, they realize their marginal dollars at that age might be getting taxed as high as 32%. So 12% today, 32% in the future. So Bill and Linda, they kind of ponder, should they intentionally pay some taxes today at 12% in order to move those traditional dollars to Roth dollars, thereby preventing a 32% tax on their traditional withdrawals in the future? That's the logic, right? In this simple example, we would call that tax arbitrage. And you might hear me say that word a lot today, that term, tax arbitrage. You know, Bill and Linda are intentionally choosing to pay 12 cents on the dollar today to save 32 cents on the dollar in the future. That's a 20-cent tax arbitrage. And so that's the kind of thing, if that's in your financial plan, it might really pop out at you. There's a really good chance that you're a great candidate for a Roth conversion. So we'll move on now to the next question. When are typically the best years to consider Roth conversions? And then also, what might get in the way of you successfully doing them? So the best times involve little other income in your life. And then what might get in the way are the consequences of realizing too much income. It really is that simple, and we will get into much more detail throughout this episode. But specifically here, for many retirees, the years after they've stopped working, but typically before they've started claiming Social Security and certainly before RMDs start. Those are really good years to consider Roth conversions, or at least what I should say is like those are the years where you're most likely to be a good candidate for Roth conversions after you've stopped working, but before any other retirement income has come into your life. Now, just because you've started collecting Social Security, you still might be a good candidate. I'm not saying that it precludes you, but I'm just saying the more income you're collecting, the less likely you are to be a good candidate for Roth conversions. However, depending on when you retire, what age you retire, you might be relying on something like the Affordable Care Act, ACA, healthcare, Obamacare, and the costs of ACA, and really it's the premium tax credit that you receive to help you pay for the costs, that's tied to your income. And so too much income means higher healthcare costs. So if that sounds like you, well, then doing Roth conversions might not be good. It might not work because injecting more income into your life via Roth conversions could have a negative effect. It's almost like in medical terms, I think they call that a contraindication. It's like when two medicines don't work together, or when one medicine and one symptom are really bad. These things can conflict in some way. So there's a lot of that going on in financial planning. And by the way, if I just got that medical term wrong, please ignore everything I say. I am not a doctor. The last question in this little preamble that I have is, how do you measure if Roth conversions will be or were successful? You know, in other words, here you are, maybe you're 57 years old, you think you're a good candidate for Roth conversions. Like, how do you really know? Or maybe a better question is like, at what age in the future will you know for sure if the Roth conversion you did at 57 was good? And how are you going to calculate it? So the challenge with this question is that it's based on many, many different assumptions. And a lot of those assumptions, we're just simply not going to know whether our assumptions were right or wrong until 10 or 15 or 20 more years play out, right? You need to assume future tax rates. That's a huge one. You need to assume future investment returns. You need to assume your future portfolio withdrawal rates. You need to assume a particular time value of money. Time value of money is that recognition that $1 today is worth more to you than $1 in the future. So you can think of that as maybe an opportunity cost calculation. Aesop with his fable, a bird in the hand is worth two in the bush. That's all time value of money stuff. And so the more murky or gray your assumptions are, where you just simply don't know what's going on, there's a good chance that Roth conversions might not be a good fit for you. But also what I'll say is that the more similar your future looks to your present, I'll say that again, the more similar your future looks to your present, the more likely Roth conversions might not be a good fit. Meaning, if you're currently 55 and you're going to pay 22% tax rates on your conversion right now at age 55, 22% taxes, but then by your analysis, you're only going to save an assumed 24% tax rate when you're 75, that's like kind of similar. Your tax arbitrage, going back to that term that we defined a couple minutes ago, is 2%, 22% today versus 24% in the future. And that might be too close to actually be a worthwhile Roth conversion. There's too much time. There's 20 years of time there where there's a lot of unknowns that are going to happen. And the tax rates are very, very similar. So it's kind of this thing where you say, like, what are the odds that all of your assumptions actually work in your favor over the next 20 years? And would you actually rather pay the tax today, waiting 20 years worth of opportunity costs where you're out the money that you paid today? It's gone. And now in 20 years, you're hoping to kind of recoup that money via a 24% savings in the future. That's where Roth conversions can get really, really murky. But I'll paint a little bit of a counter picture there. If you're 69 years old today and you're going to pay 10% and 12% today on your Roth conversions, knowing that you're going to save 24 or 32% when you're 75 years old. I mean, that sounds like a home run. Again, in that example, there's a 6-year waiting period between age 69 and 75 to save something like 20 to 25%, even maybe even more on your taxes. That sounds like it's probably a home run. And then the very last thing I'll say before getting into your listener questions, and I think I probably addressed this on a previous episode, I do think that Roth conversions are a bit oversold, right? They are sometimes pushed too much or just talked about too much. Some people almost speak about Roth conversions the same way they speak about getting a driver's license or voting. It's like, of course you're going to do it. Of course you're going to do it. It's just a matter of reaching the right age, of reaching the right stage in life. You have kids, you work your job, you buy the house, you retire, you do your Roth conversions. It's just a matter of course. And I think the financial media and the financial services industry, of which I'm a member of both, guilty as charged, certainly kind of fan the flames of this conversation. I think instead we need to think of Roth conversions as another one of these great examples where we need to let the numbers be our guide. Some of you, many of you, maybe even, will never have a smart opportunity to do Roth conversions. Or perhaps any Roth conversion that you do will just be some kind of tiny drop in the bucket of your overall portfolio. Or maybe if we approach it from the other angle, from the other side, it's that if you try to force Roth conversions into your plan, the numbers would suggest you actually might be worse off for doing so. So before getting to your questions, I guess just to reiterate that point, Roth conversions are not a universal good. They can be great. They have potential to be good, yes, but they also can be neutral, or they simply might just not be worth your time. They also could be net negative, costing you more in taxes and leading to worse after-tax outcomes, leading to worse financial planning outcomes. So they're not as universal, certainly not as universal as getting your driver's license or voting. And that's the preamble. So now let's get to the questions from listeners like you. First, from Roger. Roger says, with all the back and forth about Roth conversions, it makes me want to just not think about them and not do them. What's the worst that could happen? But seriously, how big of a deal do you think it is when a quote unquote good candidate for Roth conversions doesn't do them? So great question to start us off here, Roger. And there's an important reason why I'm starting here. The reason is that, the quote unquote best candidates for Roth conversions, the people where the math seems to be an obvious no-brainer, are also typically people for whom Roth conversions are simply a cherry on top of their ice cream sundae, a nice extra, right? A nice extra tax savings in what is already a sound financial plan. So let me explain. Let's say a couple is married filing jointly. They're 65 years old today. They look at their future Social Security income, their dividend and interest income from their taxable account, their future RMDs when they'll be 75, which is 10 years from now. And they realize, whoa, we're going to be paying like 35% on our marginal dollars. That is so much tax. And this is all federal tax. And to that end, well, they're not wrong. 35% is a pretty high tax rate on their marginal dollars. But let's just pause a second because we need to ask, how much income does it take to be in the 35% marginal tax bracket? And the answer is, for this married filing jointly couple, over $500,000 in income. Meaning these people have a lot of retirement income. Because remember, they're retired. This is all retirement income. It's not even W-2 income from jobs. So we also know that a large chunk, probably more than half of that amount, is coming from their RMD. Social Security, after all, can only be so big. And that begs another question. How big do your traditional retirement accounts need to be in order to generate some RMD of $300,000 or $350,000 or $400,000? And the answer there is like 8 or 9 or 10 million in size. So let's rewind back to age 65, before this couple has claimed Social Security, before their RMDs start, where the only income they receive is in interest and dividends, and they might have lots of space in their tax returns for Roth conversions. They are probably a great candidate for Roth conversions, right? Paying a 12% tax today in order to prevent a 35% tax in the future. That's wonderful. Or you could even look at through the lens of, they're just paying 12% taxes today to lock up those dollars in a Roth account forever. You can look at Roth conversions through that lens alone and convince yourself it's a pretty smart thing to do. In other words, you could say, I have no idea what my future tax rate is going to be, but I'd happily pay 12% taxes simply to lock dollars in a Roth account forever. Okay, that's fine. But going back to Roger's question, if this family never pursued a Roth conversion in their life, are they at risk of not fulfilling their retirement dreams? If a family ends up with $10 million in traditional accounts alone by the time they're 75, even if, again, it's all traditional, it's all pre-tax, are they at risk of ruin? Probably not. So that's my point. This family is a wonderful candidate for Roth conversions. They are also in a wonderful position, regardless of whether Roth conversions existed or not. To them, the Roth conversion is just a cherry on top. Now, they absolutely would be missing out on something pretty smart. And from that perspective, what they would be doing if they skipped Roth conversions, skipping Roth conversions would be suboptimal, but it's not going to prevent them from summiting up that mountain. So a financial plan has dozens of little knobs to measure and turn and dial in, and Roth conversions are certainly one of them, but you don't need to get every single dial perfect in order to have a good retirement, that's for sure. In fact, you can make the argument, as I did on some recent episodes about balancing out different type of risks in your retirement, you can make the argument that it's impossible to get every single dial perfect, because sometimes dialing up one thing over here is naturally going to force you to dial something down over there. But the point is, if you're comfortable with the concept of Roth conversions, you're comfortable with the math, you've convinced yourself that you're a good candidate, Roth conversions certainly are a dial that you can and probably should try to hone in to your advantage. Here's a quick ad, and then we'll get back to the show. Hey listeners, Jesse here. My team and I are preparing for episode 150 of the podcast, which we'll be recording in a couple weeks, and we thought it'd be fun to do an Ask Me Anything episode. And many of you know that my normal Ask Me Anything episodes focus entirely on retirement and financial planning questions. Well, we want episode 150 to be a little different. We're going to open it up to just about anything. Ask me anything you want. And I'm not slipping down the slope of becoming a self-absorbed influencer, but we figured, once every 150 episodes or so, it could be fun to share a little more than tax rates and expense ratios. So if you have a question, ask me anything. Simply send an email to jesse@bestinterest.blog. Thank you. So thank you for the question, Roger. And next question from Nicole, who says, my husband and I are Gen X. When we worked, we didn't have Roth 401k options. As a result, we have a very substantial portion of our net worth, our portfolio, in traditional IRAs and traditional 401ks. Everyone says doing Roth conversions look great when you're in your low tax years, but given that the vast majority of our retirement income will be withdrawals from pre-tax accounts, we'll end up remaining in the 22% tax bracket throughout most of retirement until RMDs kick in. Does it ever make sense, Nicole asks, to do micro Roth conversions? So instead of converting $50,000 or $100,000 at a time up to the top of a tax bracket, what if we just convert $5,000 or $8,000? Convert just enough that it doesn't hurt too much to pay the additional tax on it in a given year. And Nicole says, on our $2 million pre-tax portfolio, it doesn't really seem like a $5,000 conversion here or there will get you anywhere, but I could be wrong if the money compounds for 20 or 30 years. So thanks for the question, Nicole. I understand where you're coming from, and I'll start by saying this. If you're a good candidate for Roth conversions, then doing something is certainly better than doing nothing. And also, you might not really know until you're 75 or 80 or 85 years old. You won't know until then, as you're looking backwards to today, what the perfect strategy would have been right now, right? In hindsight, looking through the rearview mirror, you're going to see perfectly what you should have done. But as we sit here today, looking through the windshield, it's very, very foggy. You don't know exactly what today the perfect strategy is. So from that point of view, I have heard some pretty smart financial planners say that they do always err on the side of doing too small of Roth conversion. You want to compare two possible sins. Like that's kind of what we're talking about here. Would you rather sin too much or too little in your Roth conversion? And if you keep your Roth conversion too small, and that means that you pay too much tax out in the future. But if you make your Roth conversion too big, that means paying too much tax today. And from a time value of money point of view, I'd rather not pay too much tax today. Now, personally, I do think there are a couple slippery slopes that you want to avoid here, Nicole. The first one goes back to Roger's original question. You certainly could find yourself with quote unquote micro conversions that are so small, or at least so small compared to where the math would lead you, right? Where the objective sized conversion would be, that you're simply under optimizing. Now, it's not a terrible sin, but it's also not ideal. Now, what do I mean there? If your financial plan, if your software, or if the expert you're talking to advises you to do a $30,000 Roth conversion, let's say, he says, hey, this is optimal. The software says this is optimal. And you choose instead just to do a micro conversion of $4,000. I mean, yeah, you're erring on the side of being too small, but it also sounds like you're just not taking the smart advice. But then the other slippery slope that I'd point out here, and I'll likely touch on this later in the episode, occurs when someone is outright not a good candidate for Roth conversions at all. Maybe they're still working, for example, and they're just earning lots of income. And yet this person tells themselves, oh, you know what? I just want to do a small Roth conversion this year, just to say that I could. And again, the problem there, of course, is that if you're in your high earning years and you already have tons of income, you're only shooting yourself in the foot to do a Roth conversion. And sometimes people will say, but it's just a small one. It's just a small one. And then that's a case where you say, the right number for you right now is 0. You should do 0 Roth conversions in this particular year. And any number greater than 0 is absolutely a mistake and you shouldn't do it. So again, that's just that slippery slope where people say, but it's just a small one. It's a behavioral slip up. And I guess that's what I'm saying here. These are behavioral slip ups because we often conflate this micro idea with, well, it must be harmless. I won't even feel it. And so while I agree that the consequences of a small mistake are by definition going to be small consequences, I also think it's important to say, let's try to not make this mistake in the first place. So thank you for that question, Nicole. And the next one is from Gerald. Gerald says, Jesse, what about wash or neutral Roth conversions? I've seen different opinions in various DIYer forums. What are your thoughts? So great question, Gerald. And listeners, let me explain this idea of a wash or a neutral Roth conversion. It refers to the idea that someone knows their tax rate won't really be changing, They're simply choosing to pay taxes today at, say, 22% to get the money into Roth rather than paying 22% on some RMD at some point in the future. They are knowingly not saving on taxes, but they value having fewer dollars in their traditional IRA and more dollars in their Roth IRA. And yes, this is where you say, well, objectively, there's no objective mathematical tax reason, at least, to do it. But sure, there are some subjective good reasons to think this way. And what I want to do in this answer, Gerald and listeners, is point out some of those subjective reasons so at least you know them, because I really think this is where we're getting to a little bit of gray area and your mileage may vary. So the first and most obvious subjective reason is simple RMD management, required minimum distribution management. Many people don't like the idea of being forced to withdraw money from their traditional IRAs via RMDs. And many people would say that if you're going to force my hand, I'd rather you force it less than more. I'd rather my RMD be only $100,000 instead of $110,000. And these neutral or wash Roth conversions give you more control over your future RMDs and therefore more control over your future taxes. The next reason that sticks out to me is the so-called widow's tax trap. When one spouse dies, when the first spouse dies, the surviving spouse goes from married filing jointly to a single filer. Now, if this has happened to you recently, or if you know someone that's happened to, usually what happens is that in the year that the first spouse died, the surviving spouse can still file jointly that year. And then the following year after the first spouse died, that's usually when they're forced to start filing single, in case it ever matters. But what happens, of course, is that it instantly cuts every single tax bracket in half. And the surviving spouse often maintains approximately the same income. Again, if a lot of this is RMD income, what will happen is that now the surviving spouse has all of the IRA income in their name alone. The RMDs really haven't changed usually. So a lot of times that same income is kind of thrust or foisted upon the surviving spouse at higher tax rates. And this is the so-called widow's tax trap. And the logic of doing a neutral or a wash Roth conversion while both spouses are still alive, converting now at the joint tax rate protects the survivor from converting later at some higher single rates or taking RMDs later at some higher single rates. So again, the widow's tax trap is one of the reasons why you might want to consider a neutral Roth conversion. The third reason is the psychological value from certainty. Tax law uncertainty exists. We don't know where future taxes are going to go. So knowing that your retirement money has already been successfully taxed can remove some anxiety about future tax law changes. And some people simply sleep better at night knowing that they don't owe the government any money. They don't own this IRA that's essentially a deferred liability to the IRS. The next reason has to do with estate planning. Roth accounts have no RMDs during your lifetime, and they don't have any RMDs even after you pass them on to an heir. And that makes them just a cleaner account to pass on. A traditional IRA left to heirs, it comes with a complex and sometimes contentious tax liability, whereas the Roth IRA is just money that your heirs receive inside of a Roth account, no less. No embedded tax time bomb, easier to plan around, simpler for executors and heirs to understand what's going on. But to end your answer here, Gerald, I do want to push back on something, and that's the idea, again, that these neutral Roth conversions, I don't think they're actually neutral. There's certainly not no cost associated with them. You're thinking to yourself, well, there's no cost. I convert today at 22 instead of paying 22 later. And that is often how they're discussed. But you are paying an opportunity cost by choosing to pay those taxes today instead of paying them out in 30 years. Or 20 years or 10 years. Now, obviously, 30 years or 20 years or 10 years, that timeline makes a really big difference as far as the time value of money as to how much opportunity cost you're paying. So if you are, say, 50 years old right now, and you're thinking about making a neutral Roth conversion, even though you won't start saving that money until RMD age at 75, those 25 years of opportunity cost, I think, are really important to consider and might make this neutral Roth conversion pretty bad. But I'll contrast that and say, if you're 70 years old today and your RMDs are starting in 3 years at age 73, and you're making a neutral Roth conversion for one of these subjective reasons we just talked about, well, now all of a sudden you say, well, it's 3 years of opportunity cost. That's not that much. Again, if you just throw something into some sort of compound interest calculator, it's also just not that much uncertainty to deal with. Like, you can feel relatively confident over what the world might look like in 3 years. So my point is that you can make a much more clear decision about a neutral Roth conversion in that 70 to 73 example that you really can't make if you're 50 and you're looking out at age 75. So just my parting thoughts there. Gerald, thanks for the question. And we'll go down to the next question from Susan. We've been told that Roth dollars are better to leave behind for our children as compared to traditional dollars. What are your thoughts on aggressively pursuing Roth conversions in order to help our children out? Susan, great question. That's true. Roth dollars are better to leave behind to your children. Now, why? Well, it's because those dollars won't come out with any tax bill for your kids. When a non-spouse inheritor receives your Roth IRA, they do have to empty the account within 10 years, the so-called 10-year rule, but there's no associated tax bill with their future distributions from that inherited Roth IRA. But yet again, we need to be asking ourselves, at what cost? Because basically, Susan is saying that she is going to prepay the taxes during her lifetime, thereby preventing any tax bill that her children would otherwise pay. Because if the kids inherit a traditional IRA, they must empty it within 10 years as well. But those distributions are taxable to the kids as income. So that's the way a inherited traditional IRA works. So you do want to be a little bit careful here, Susan. Any way you cut the cake, this is a case of you taking on some pain so that your heirs won't have to. And the question becomes, I guess, can you afford to take on that pain? Are you putting your retirement at any sort of risk in order to pay these taxes? And perhaps even before that point, we really want to make sure, how much money are you actually going to be saving your kids? You know, there's a chance that your tax rate as a retiree might be higher than their tax rate as an heir. So how much are you actually saving them? It's nuanced here. There's a chance that your tax rate as a retiree might be higher than their tax rate as an heir. So what you might end up doing here is spending more dollars from your taxable account. Follow me here. You're spending more dollars from your taxable account to pay the Roth conversion taxes, right? Roth conversions come with taxes, as we know. How are you going to pay those taxes? With money from your taxable account. That's the smart thing to do. Well, if you're paying money out of your taxable account to cover a tax bill, that leaves behind less money in your taxable account. You have fewer taxable dollars to leave to your heirs. So sure, you've left them now some Roth dollars instead of some traditional dollars, and that supposedly is a good thing. But you would have been better off leaving them a bigger pile of the taxable dollars with which they could have paid taxes on their inherited IRA distributions at more preferential rates. I do realize as I'm rereading, and as I was saying that out loud, I'm not sure if there's necessarily a better way to explain what I just explained. The point is, it is more complex than simply, I'm an heir. Would I rather receive a Roth account or a traditional account? It's far too simple just to say that inheritors would rather get Roth dollars, and therefore that you should convert more to Roth. There are many realistic scenarios where that strategy would not only make your retirement more difficult because you're kind of prepaying this tax bill, but it would also actually leave fewer dollars in your heirs' pockets. And you say, well, where does the money go? And the answer is it goes to the IRS. By prepaying the tax bill here via Roth conversions, you might end up giving more money to the IRS and less money to your heirs. So you really want to check your personal tax situation. And because this is an estate planning question, it actually involves your heirs' tax situation too. You really want to check this before you go off and execute it. I think the best case scenario here would be where you know that Roth conversions are really going to help you during your living years, but then incidentally, that the Roth conversions would also be a better way for your heirs to receive assets from you. So the best case scenario would be it's that win-win situation. So thank you for the interesting question there, Susan. Next from Charles. Jesse, is there a dollar cost average versus lump sum equivalent for Roth conversion? What's your opinion on the strategy here? Interesting question, Charles. I think the underlying question here has to do with the timing of Roth conversions. So first, let me lay down a few fundamentals. First things first, each tax year presents its own unique opportunity to execute Roth conversions or do any other type of tax planning. The deadline for doing Roth conversions is December 31st. Now, are there good times or bad times in the year to make Roth conversions? I say so, yes. Some people prefer to wait for negative market performance before making a Roth conversion. The core idea is that when you convert, you pay tax on the current dollar value of the shares, not on what they'll eventually be worth. So if your IRA holds, say, $100,000 worth of stock, that was actually worth $150,000 6 months ago. You convert that money at the depressed value, paying tax on $100,000, and then the market recovery happens inside of the Roth account and then occurs completely tax-free. You're essentially locking in a lower tax bill on the same number of shares, and the IRS never gets to participate in the rebound, so to speak, in the market. But we'll come back to this because I'm not a really big fan of that kind of timing the market, waiting for negative performance strategy. Because the next argument is to convert as early in the year as possible, The argument here is that as you get more dollars into Roth accounts earlier, it'll certainly lead to a better compounded return in the Roth accounts over time. More Roth dollars, fewer traditional dollars, a better tax situation. So you just want to get more money into the market earlier, right? You want to invest early and often as early as possible. So why wouldn't you want to Roth convert as early as possible? That's the logic there. But having gone through these conversations many a time, I have serious hesitations about both of those strategies that I just outlined. I have serious hesitations about waiting for negative market performance. I have serious hesitations about converting as early in the year as possible. Or at the very least, I think you want to be cautious about using either one of those strategies. The rationale is that sometimes it can be very hard to predict how the rest of your tax year will unfold. So let's say you make a big Roth conversion in January, early in the year, or maybe there's a big market dip in March and you react to that market dip with a Roth conversion. The problem is if you get some surprise income in October, you may now be subject to higher taxes than you originally thought. Or put another way, that Roth conversion that you thought would be a smart tax move ends up being not smart due to surprise income that you didn't think was coming. You never knew it could have been coming. So what do I recommend instead? I recommend you basically wait until the fourth quarter of the year to run your personal Roth conversion math. Do it in October or November. Figure out all your numbers, how they all look for the year, because you'll be about 90% of the way through the tax year at that point. And then you say to yourself, well, what are the odds I get a surprise? Because you still might get an income surprise in some way, but what are the odds I get a surprise at this point in my year? The risk is that some surprise income kind of comes up in December or something like that. So I would just make sure you give yourself at least a couple weeks of wiggle room in December, because the major custodians, the Schwabs, the Fidelities, Vanguard, they do get really busy at the end of the year. And you don't want some logistical hassle to keep you awake at night, unsure if your Roth conversion actually went through in the correct tax year. And now, if you follow the strategy that I just outlined, you know that there will be some times when you look back on the past year and you do wish that you had pulled the trigger in January or in April or in August or whatever. You know that there will be times where you have that regret. But you also know that you're going to be avoiding a pretty big trap. You're going to be avoiding the trap of a regretted conversion where you converted money early in the year only to realize later that it was not the right move in hindsight. So personally, I think that avoiding that trap and avoiding that regret from messing up is the better thing to do. And that's why I recommend waiting toward the fourth quarter of the year to do your Roth conversions. So thank you, Charles, for that question. And the next question is from Jason. Jesse, I'm reading that you used to be able to undo Roth conversions in some way. Is that true? Because if I'm thinking about it right, if I do a Roth conversion and then the market drops, I'll likely be regretting it and want to undo that conversion, correct? Jason, thanks for the question. And yes, you used to be able to undo a Roth conversion. They changed the law with the Tax Cuts and Jobs Act in 2018. Before that point, before 2018, you could do a tax recharacterization to retroactively reverse a Roth conversion. To be totally honest with you, I don't even know how the underlying mechanics works. Like if there was a certain time period, maybe it was like within the same tax year, you were able to convert and then unconvert or something like that. All I know is that you cannot do it anymore. At this point, all Roth conversions are final and irreversible. And so going back to Jason's question, I mean, what happens if your portfolio drops 20% the very day after you execute a Roth conversion? Yeah, what happens is you got hit with some pretty bad luck, plain and simple, because it means you'll be paying income taxes on the 20% of the conversion that once the market drops is no longer actually there in your portfolio. You'll pay taxes on a $10,000 conversion, even though you're looking at your account and there's only $8,000 in the account. It's just bad luck. There's no other way to put it. But similarly, if the market goes up 20% the day after your conversion, you won't be paying taxes on that big chunk of investment growth. You pay taxes on $10,000 even though the account says $12,000. That's a stroke of luck. And yeah, this is now definitely an extension of the last question from Charles about the timing of your Roth conversions. So again, I'll reiterate that logic and explain it a different way. And the different way is we do not want to attempt to time the market. Now that's just broad and helpful investment philosophy in general, but we can certainly apply it here to Roth conversions specifically by admitting to ourselves that sometimes the market will go up after we convert and sometimes it'll go down after we convert. And that is just the nature of the beast. Over the long run, it'll average out in our favor. Therefore, the only true timing for Roth conversions ought to do with the tax aspect of it. Namely, if you do a Roth conversion early in the year, you're facing the fact that something could occur tax-wise over the next 9, 10, or 11 months, and that'll make you regret the Roth conversion you did back in January. Whereas if you delay your conversion until October or November or December, you're dealing with a lot less uncertainty. Now, at the end of the day, we do not do Roth conversions for anything having to do with better market performance. It's not that we're trying to time the market or achieve better returns from our index funds or anything like that. That's not why we do Roth conversions. Instead, all we're trying to do with Roth conversions is achieve a better after-tax result. Therefore, to do something in your Roth conversions that might jeopardize your tax efficiency or even outright sabotage, right, and create a net negative damage to your taxes, that is something that we want to avoid. Here's a quick ad, and then we'll get back to the show. Did you know my written blog, The Best Interest, was nominated for 2022 Personal Finance Blog of the Year, and it's been highlighted in the Wall Street Journal, Yahoo Finance, and on CNBC? I love writing, especially when that writing is to share financial education, and I usually write 1 or 2 articles per week. You can read them all at bestinterest.blog. Again, the web address is bestinterest.blog. Check it out. So thank you for that great question, Jason. I appreciate it. And next one comes from Diana. And Diana says, hi, Jesse. We're likely going to move in retirement from Minnesota to South Carolina. We're not exactly sure when we'll make the move, but should I wait on Roth conversions until we figure out where we move? Thank you, Diana. An amazing question, and it gives me an excuse to talk about state taxes. Everything I've referred to so far in this episode has to do with federal taxes, but state taxes really matter too, listeners. The thought process here from Diana is that, yeah, many states count Roth conversions and other IRA distributions as taxable state income. Not all do, and that's where you really want to be careful on the state tax side because many states treat some, if not all, retirement income with special tax rules. Usually it's lower tax rules where either some portion of your Social Security or maybe all of your Social Security won't be taxable by the state. Some portion of a pension or maybe all of your pension won't be taxable by the state. And same goes with some portion of your IRA distributions or some portion of a Roth conversion might be taxable or might not be taxable. You really want to be just prudent and pay attention when it comes to state taxes and retirement. And Diana here, the logic makes sense that South Carolina in general does have a lower tax regime than her current state of Minnesota. So again, her question kind of the logic is, do I want to overpay for my Roth conversion in Minnesota, even knowing in the future I could just wait and kind of underpay or just pay less in South Carolina? First, what I'm actually going to say, Diana, I crunched the numbers in your actual situation. I think you'll probably find that the two states are extremely similar. You know, I used what I consider to be a very typical average American retiree as far as some of the numbers go. And I found that the South Carolina tax is probably going to save you less than 1% of the total conversion amount. So specifically in my example, on a $100,000 Roth conversion with a couple other minimal retirement income sources, Minnesota charged $6,400 in tax and South Carolina charges about $6,000 in tax. So just, they're very similar is my point, Diana, but let's put a pin in that. Let's put a pin in Minnesota and South Carolina and instead pivot to maybe a bigger, broader example. Let's compare California or New York, two notoriously high tax states, versus Florida, a very well-known retirement state for many reasons, including its 0% income tax. Now, the tax rate difference in this scenario, depending on, again, how much income we're actually looking at, the tax rate scenario is going to be somewhere between a 6% tax delta all the way up to maybe like a 12 or 13% tax delta. And that is the kind of difference, I should say tax arbitrage, I guess here, right? That's the term I've been using all day. So that's just the state tax alone. And that's the kind of difference that really matters. Because, I mean, let's think about the federal tax brackets for a minute. The federal tax brackets here, 10%, 12%, 22, 24, 32, 35, 37. Now that we know those tax rates, a rough rule of thumb, and again, just a rule of thumb that gives you direction here, is that if you're not getting at least a 10% tax arbitrage in the federal tax brackets, you might want to pause and really dig into the numbers. If you're getting more than a 10% tax arbitrage, you're probably a pretty good candidate. But if you're getting less, you might want to think about some of the gray area and some of the subjective stuff we've talked about here. So if you're converting at 12% today, instead of paying a future rate of 22%, great. You're getting a 10% tax arbitrage. Likely means you should be pretty serious and a good candidate for Roth conversions. And now I explain that because it gives us a good reference for the possibility that Diana points out here, which is a negative state tax arbitrage. If you believe that you'll have a federal tax arbitrage of 10% to the good, but then a state tax arbitrage of 6% to the bad, well, boy, that state tax just took a huge bite out of your potential gain. State taxes can really, really matter. So again, here I am. I live in New York State, right? I'm in upstate New York. And if I were doing Roth conversions right now, contemplating the fact that I might move to a Tennessee or a Florida in retirement, it's really going to matter. The difference between a New York State income tax and those states' income taxes is pretty meaningful. Now, if you're never going to move states, you can reasonably ignore this idea. Or at the very least, all you need to do really is a much simpler comparison. It's your personal state tax rate today versus your personal state tax rate in the future. You're paying the same taxes, the same brackets exist. Your income level might shift, and your income level shifting might change your tax rate. But still, it's pretty easy. But if you are going to move states, especially to a state with a low income tax or with zero income tax, it's vital you account for that change when you're approaching any sort of tax planning, including Roth conversion planning. So thank you for that question, Diana. And that brings us to the final question of the day from George. George says, Jesse, I feel like I'm tiptoeing through the proverbial minefield when it comes to Roth conversions and how they interact with my Social Security taxes and my IRMAA taxes. And, well, I don't even know where all the mines are, says George. So do you have a checklist or something I ought to go through when planning my Roth conversions? Cool question, George. I intentionally saved it for last. And hopefully, listeners, this leaves you off today with an interesting reminder, a list of interactions that Roth conversions can have in your retirement plan. And what I think I'm going to do, in fact, is turn this answer, this checklist that I put together, into a document that you can use. So if that would interest you, just send me an email to jesse@bestinterest.blog. Maybe you can reference the Roth conversion checklist from episode 145. And as long as a few of you are interested, I'll make this thing nice and neat. I'll try to polish it up. And then I'll probably just send it out for free to my full email list, which I suppose actually is a shameless and easy way for me to plug it right now. Make sure you sign up for my weekly email. You can do so from the homepage at bestinterest.blog. And that email list, by the way, is the one and only way that I kind of contact you all on a regular basis. So again, if you want to get the copy of this Roth conversion checklist, drop me an email and let me know. So let's do the list. I'll go through it. I intentionally kind of made it choppier. I didn't go into too much detail as I usually do because otherwise we might be here for another hour. Instead, I think this will take us another 5 minutes. So here's the list, the Roth conversion checklist. First, we have to do tax rate analysis, and this is very much a core exercise. 1, we need to look at our current rate versus our future marginal rate. You need to estimate your tax bracket now versus when you're in retirement or later in retirement. The conversion makes sense when today's rate is considerably lower than expected future rates. 2, you need to look at your tax arbitrage window. You need to identify years where income will be unusually low, which could be early retirement. It could be from an investment or a business loss. It could be because of a year of really heavy deductions, and that might be a prime Roth conversion opportunity. 3, the bracket filling strategy. You need to calculate how much room remains in your current tax bracket and consider converting only up to the top of your bracket to avoid pushing into a higher bracket. That's not a hard and fast rule, I will say, for just a little bit of more clarity there. If you push to the top of the 10% bracket, you're probably going to be fine continuing on into the 12% bracket. But the thing you might not want to do is push beyond the 12% bracket because that you end up paying in the 22% bracket. And that's where you say, well, maybe the conversion no longer makes sense if you're paying 22%. Anyway, on to number 4, state income tax. You want to factor in state tax on the conversion. As I mentioned earlier, some states offer deductions for retirement income, and that makes today's effective rate quite a bit higher than the federal rate alone. Is it retirement income? Is it conversion income? Does the state treat it differently? That can really matter. On to the next core set of ideas, what I call break-even analysis and time horizon. This has to be one of your core parts of your analysis. So number 5 on this list, break-even analysis. Calculate how many years it takes for the tax-free Roth growth to offset the upfront tax cost. A shorter remaining investment horizon could mean it's harder to justify. The money that you use to pay taxes today exits your taxable account permanently, and you need to compare the long-term compounding value of keeping it invested versus the Roth benefit. Number 6 is future tax law uncertainty. Again, we don't know how tax rates are going to change in the future. The possibility of a rate increase strengthens the case for converting right now. Number 7, state of residence changes. This goes back to Diana's question. If you plan to move to a no income tax state in retirement, converting now from a high tax state reduces the value of your conversion. So that gets us through the break even and time horizon tasks. And now maybe this part of the checklist, we're starting to get into really some of the questions that George, thank you, was asking. So the next section I call competing uses of the same tax space. So number 8 on our list gets us to tax gain harvesting. Long-term capital gains and qualified dividends occupy the same bracket space as Roth conversions. Harvesting gains at 0% might be more valuable than a Roth conversion in the same year, and you ought to consider it. Number 9, this one goes out for the business owners, the QBI deduction, the qualified business income deduction, especially I think it's for self-employed business owners here. So if you add conversion income into your tax space, it could reduce your QBI deduction by pushing your income past a phase-out threshold, and you want to avoid that. That gets us to number 10 here, I think, which is just other deduction phase-outs in general. Roth conversion income can phase out deductions like student loan interest deductions, rental real estate loss allowances, and some others. So that's where it's good to consult with a professional on that case. The next main section here I call Social Security and Medicare. Brings us to number 11 on the list, Social Security taxation bump zone, right? Social Security benefits go from not taxable at all to half of them being taxable, up to as much as 85% of them being taxable as income. And Roth conversion income can push you across these thresholds, and that creates a effective marginal tax rate much higher than the underlying income tax rate. That's a weird concept. It probably deserves like 30 seconds of explanation. So the idea is that you can run into these situations where you do a Roth conversion and of course, the Roth conversion's at 12%, so I'm just paying a 12% tax. Well, sure, the $1 you just converted, you pay 12% tax on that. But what you don't realize is that the $1 you just converted also means that one of your Social Security dollars that was previously untaxed is now going to be taxed. So yeah, you pay 12 cents of tax on the dollar you converted, and now maybe you also owe 12 cents of tax on the previously untaxed Social Security dollar. So they call that the Social Security bump zone, and it's certainly something you want to be aware of when you're doing any kind of tax planning. Next on our list, and I'm kind of forgetting the numbers, so I'm just going to start skipping the numbers. What is this, number 12 maybe? IRMAA surcharges. So Medicare Parts B and D, those premiums can jump up due to the IRMAA surcharge at particular income thresholds based on your tax return from 2 years prior, which is why IRMAA planning, it's a small thing, but it's also an annoying thing. It kind of sticks in people's sides in a frustrating way. A large Roth conversion could trigger IRMAA surcharges that cost hundreds of dollars per month per person in your relationship. So you want to be aware of IRMAA. Next on the list is the net investment income tax, NIIT. Roth conversion income itself is not subject to the NIIT, but Roth conversions raise your modified adjusted gross income, which pushes investment income, or can push investment income above the NIIT threshold, triggering a new 3.8% tax for you to think about. The next section on this list is the payment of taxes itself, because again, Roth conversions cause taxes, and you want to try to pay those taxes from outside money. If you're using the IRA money itself to pay for the conversion tax, it often negates much of the benefit of the conversion in the first place. The conversion is most powerful when the taxes are paid from an outside taxable account. The next item on the checklist is withholding, tax withholding and estimated payments. Conversion income typically is not subject to automatic withholding. Again, you don't really want to withhold taxes. You just want to convert the whole amount. You want the whole dollar amount to end up in your Roth account. You don't want to withhold taxes from it, but that means you might have to make estimated tax payments or adjust your W-4 withholding to avoid an underpayment penalty when you do your taxes. You also want to be aware of the timing and the rules around Roth conversions. You have to think about the age of the account and the 5-year rules. Roth conversions each start their own unique 5-year clock for penalty-free access of the converted principal. You also want to be aware of the 5-year rule. The first Roth account you ever open has to be at least 5 years old before you start taking money out. And then, of course, you have to think about age 59 and a half, like all IRA accounts. Next, you want to think about your RMD years. Once RMDs begin, age 73, age 75, well, you have to take the RMD. You cannot convert the RMD. The RMD has to be distributed first. If you're doing conversions in RMD years, which not many people are, you certainly want to plan carefully there. Next, you want to think about the year of death and estate timing. If your spouse or if an heir will inherit a traditional IRA and they face their own high tax bracket, well, in that case, pre-death conversions might be more efficient for the overall estate. And that actually brings us to more estate and beneficiary planning topics. You want to think about the 10-year rule for non-spouse heirs. Non-spouse beneficiaries must empty inherited IRAs within 10 years, as we already talked about here. If the heirs will be in high brackets during that window, converting during your life will reduce their tax burden. You also want to think about charitable giving plans. If you plan to donate IRA assets via qualified charitable distributions, QCDs, those dollars pass tax-free anyway, and converting them just kind of wastes some money on taxes that you might not otherwise need to do. You also want to think about estate tax exposure, and this, goes out to a minimal number of you. But if you have a very, very large estate above federal or state exemption thresholds, you might benefit from simply reducing IRA balances via conversions to just shrink the size of your taxable estate. So again, that's a niche corner case that you probably want to talk to a trust and estate attorney and a CFP or some sort of expert financial planner before you make a move like that. And then last, we have healthcare and financial aid. The last things to think about before doing a Roth conversion, because these can be pretty big. You certainly want to think about ACA premium tax credits. If you are pre-Medicare, if you're under age 65, if you're buying healthcare coverage on the ACA exchange, your Roth conversion raises your modified adjusted gross income and can reduce or eliminate your premium tax credit, which is not something that you want to have happen. If you have kids, you want to think about college financial aid, because conversion income appears as parental income on student aid applications and can reduce your student age eligibility. And then last, you want to think about Medicaid and long-term care planning. In some states, IRA balances are counted differently for Medicaid eligibility, and converting can affect kind of your Medicaid eligibility and your long-term care planning. So that's the list. Like I said, if I missed something on that list, please let me know. If you want a copy of this list, or simply if you want me to polish it up and get it in a ready-made document, just drop me an email to jesse@bestinterest.blog. And that is a wrap for this episode. I'm sure there are some great Roth conversion questions that I didn't address today, but the goal here was to expose you all to just some different good thoughts on the trade-offs around Roth conversions, ideally building up your kind of personal repertoire for how you approach the question and giving you some more things to chew on in terms of both the benefits and also the costs or the hidden traps of Roth conversions. Thank you, as always, for listening to Personal Finance for Long-Term Investors.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.